Good evening, everybody. My name is Daniel Young, and this is Adaptive Perspective. Every week, I break down the market the way I see it, separating currents from noise and opportunity from fear, using closed-end funds and income-focused strategy. It isn't polished, it's definitely not scripted, and it's not herd thinking. Here, we don't chase headlines, we navigate markets. And I'm not a financial advisor, but I am a strategist. I go where the data leads, even when that means walking alone. Different intro, but I like it. We'll see how it we'll see how it goes for the coming week. I'll sit on it, and if I need to change it, I'll adapt it from there. But welcome back. This is the Sunday navigation brief where we separate currents from noise, opportunity from fear, and figure out where the market is actually moving. And not much happened on the surface this week, but there's a lot of backstory. Think of how to say this. There's a lot of backstory explaining why very little happened and why the herd is still uneasy. So let's break it down. Before we talk headlines, remember how we view the market. Those four types of water: currents, waves, ripples, and tides. Currents move whether you believe in them or not. They exist and they pull capital forward. Waves are large disruptive events: recessions, wars, policy shocks, herd panic. Ripples are short term reactions: headlines, fear spikes, knee jerk selling. And tides are the long term consequences of collective choices, including your own. Most investors confuse ripples for waves. That's how people get shaken out of good position. So the big question remains: why are recession fears still here? Well, recession fears linger because they're familiar, they're easy to understand. Historically, inflation drops, job reports soften, and recession follows. But we're no longer in a normal cycle. Here's the divergence: GDP is still growing, infrastructure investment is accelerating, manufacturing is reshoring, data center construction is booming, and energy production continues expanding. That is not a recession setup. That's an economic reconfiguration. And a major piece of the confusion comes from what I call ghost jobs. Millions of workers entered the economy outside formal systems. The jobs were never officially tracked, but they consumed housing, fuel, food, and services. That pushed prices higher across the board. Now, ghost jobs are disappearing. Competition for fixed resources is easing, housing pressure is cooling, energy costs are falling, supply chains are stabilizing. And if it's any, gosh, if it's any sign of things to come, insurance rates might actually be falling. So inflation itself isn't falling because the Fed did something brilliant. It's falling because structural pressure is being removed. And that's an important distinction. On to technology and AI. AI is not taking jobs. It's eliminating the need for certain roles altogether. Last week, technology reached a new inflection point. AI systems no longer shut off when you stop typing. They can now operate independently, execute tasks, and build systems while humans are offline. That's powerful and unsettling. The market reacted midweek. Technology sold off, especially outside the mega caps, because the herd fears loss of control, job displacement, and unknown consequences. But companies see something else: lower cost, higher efficiency, faster deployment, and fewer human bottlenecks. AI isn't firing people, it's exposing whether a role actually adds value. That's the real labor disruption underway. So, why did markets feel sluggish? Because ripples are being mistaken for waves. Fear narratives are louder than data, and media feeds emotion, not structure. The news doesn't give you the meat anymore, just the broth, enough to stir anxiety, not enough to guide decisions. And from that thin information diet, the herd concludes inflation is falling, jobs are soft, AI is scary, recession must be coming. But the conclusion doesn't match reality. So, what do? You have to realize you cannot time the market, but you can recognize opportunity. We don't buy highs, we don't wait for the perfect bottom. We buy the dislocations that create discounts. This week we bought the dip, honestly, a week early now that I go back and look at it. But we bought the dip, not the trough, but we bought the dip. But that's how disciplined strategy works. Despite all the noise, nothing important has changed. The strongest currents remain where we've been: bonds and bonds proxies, end to end energy, and technology beyond the mega caps. Those currents are carrying capital forward, even while headlines try to pull attention back. We buy today with the coming market in mind. We don't chase yesterday's reflections. So, with that context set, let's look at the closed end fund snapshot. Here are the top funds for the opening bell and why they make my list for this week. Let me share my screen. So, last week I did a top four, and you'll see that there's, quite a bit more than a top four on here. As to what we bought last week, I will snapshot that here. So we bought these in the Roth, these in the we bought these in the Roth, and these in the cash brokerage. Cash brokers. There we go. Yeah, and beyond that, you see all my Fidelity buys because I track those for myself. So the top funds for the week, which we're going to sort it down a little bit more. DLY remains on my hit list. It's a great overall bond company. It's run by Jeffrey Gundlach, it's the guy. Uh, Amongst his peers, he's called the bond god, but it's the guy. I mean, he's made amazing market predictions, and he's generally spot on. So yes, his fund is on my perpetual wish list. But as good as it is, and as great as Gundlach is, it's not it's not a great buy for me simply because of price. At that price, I can pick up two different bond funds for cheaper, but that give me the same overall versatility. DLY is a global bond fund. I can pick up BRW that we already own and FSCO that we already own together as a package set for cheaper than what I can buy DLY. I want to say it's about 250 cheaper, and I can get a better dividend. Now, does that discredit DLY? No, it's not exactly like comparing apples to apples because they don't share the same funds. But I can buy a global bond fund that owns more than bonds and that's shareholder activist. And I can also buy a US driven bond company that's really a BDC private lending company that's great for this market and the coming market. So as much as I would love to get DLY, it doesn't make the list this week. We also have this one. I think real estate I think the potential growth or expansion and development of real estate is a really great, I don't want to say possibility, but ongoing development just sounds too cliche or too punish. So I still think real estate is a underdeveloped section of the market that has not caught up to the rest of the market. IGR runs a global real estate. I don't want to say syndicate, but REIT, and they invest in more than the common uh, single family home or apartment complex. That being said, it doesn't meet the metric on discount, but it's a great dollar cost average for me. If that if it was the best deal here, which you could argue that it is because it's the cheapest one, but if I went with just IGR, simply based on cheapest fund, uh, second to highest dividend overall, it doesn't necessarily meet the metric because the current discount is not existent. It's in premium territory, but it's a great dollar cost ad. But is it the best thing here? Maybe. It's the only true real estate only fund on the list. HGLB has real estate. Maybe some of the others do buried in their funds. So IGR could be a top contender. The everything else is in bunches. I like buying BRW and FSCO together. That's me. BRW, like I've said, is bonds, but it's also closed-end funds and crypto and minerals and metals, and it's a global outlook with a shareholder-focused approach. FSCO is an all-American company. Yes, it's a bond company, but it's really a BDC, just packaged inside a bond company. That's great for now, great for the coming market, great for the all-American mindset that we're experiencing right now across the nation. I like USA and ASG together. NBXG, I mean, that dividend is not exactly in the middle. I would think the average is 10.4, but it's close. USA and ASG, from my standpoint, work as a great package. They're sister funds, um, and they're looking at powerhouse blue chips, not companies that are all in on AI or all in on technology, but all companies that would benefit from expanded growth in technology and AI. And yes, AI is technology, but it's also like there's a divergence there because while Microsoft, Meta, Alphabet, Amazon, Tesla, who else? Broadcom, Intel, Dell, like pick your major technology company. AI is still separate. They're related, but they're separate. And AI's advancement can further help technology, which can also further help all of these other companies. So, yes, I like USA and ASG, but my drawback is that they're quarterly payers or kind of they're alternate category three payers, I guess you could say. So, true category three would be 36912. Theirs is a little bit off. And they are consistent quarterly payers. But if you want consistent monthly income, if you break it down on a monthly scale, like at 12 cents, 12 cents over a quarter, now you're looking at 4 cents per month. I mean, everything else on the list blows that out of the water. So while I do like them as a package, while they will make the list, it's really the third option on the list. BRW and FSCO, I think, is one, and it's tied with IGR, just based on how I think the real estate growth potential looks for the coming year. So that's IGR on its own, and then BRW and FSCO as a package. So that's two, or maybe tied for one. USA and ASG sits last. NBXG and HLB I like together. I mean, yes, you could buy them separately, but I like together. So NBXG is all tech. It's it's all companies that would benefit with 5G tech. And I'll pop up the description so you can see. That way you can read it, pause it, and read it on your own. But what I really like about the company, see if I can quickly find it in here, is they sell covered calls. Let's see. There we go. right there. So they sell covered calls, which for a very up and down market, that's great strategy. So for a very volatile market, covered calls make a lot of sense. I also like it because the technology side of things. So to pair the two together, I see great promise and potential in that for that in this market and in the expanding technology and AI market space. HGLB, for a while, I was hesitant on. Honestly, I was considering selling it for a while, but we just picked up another 100 shares of it. So what changed? I like their portfolio enough that I copied it down. So it's really hard to find the Highland portfolios or say that to find the current versions of a Highland portfolios off of any other website besides the Highland website. So uh, Morningstar has decent info, CF Connect has decent info, but if you want the true value and breakdown of the Highland portfolios, you're just better off going to their website. I love I love what they've done. They've made some changes. Um, Midwave Wireless, yeah, makes up a gosh, almost 35% of their portfolio, but almost 72% of their portfolio is vested into the top 10. So it doesn't give you a lot of wiggle room on the backside. The con of that is if any one of those drops, then you're going to see it reflected in price because all of those weigh significantly on the portfolio. But what I really like is this. And it seems just like a random company. But I looked it up a couple of weeks ago, and it's a new data center company housed in Texas. I like anything Texas invested because I live in Texas. But I love that it's a new data center and a new, say, like a data center venture because the U.S. needs data center. We need energy growth. We need great expansion. But in order for all the technology and the AI and the continued development of just your cell phone technology, we need more data centers. And those data centers need utilities running to them. So I love the fact that they've changed the portfolio a little bit. And honestly, it's risky because that's a startup company, but I like the risk. I like the push. So I would outside of IGR, I like IGR on its own as it relates to my portfolio. It's a great dollar cost average buy, and it pays a great dividend, even though it doesn't meet the normal metric on buying the discount. Outside of that, I like BRW and FSCO together. So we have IGR1 on its own. Now we have BRW and FSCO. If you want to put them in order, maybe two or tied for one. Follow that with HGLB and MBXG, and follow that with USA and ASG. And that's the list for the week. So a little bit more than a handful, but maybe less if you group them in batches. So that's really all I have. I mean, that's it for the week. Same strategy, updated data, better positioning. And I hope this helps you. So if you have questions or comments, by all means, tag them in the comments, leave me a comment. Tell me if you like the new format. Tell me if you don't like the new format. Tell me if you like the picks, you disagree with the picks, or even share what you're buying. And I really do. I read the comments, I reply to the comments, and I really do appreciate your feedback. So, whatever you have for the week, I hope you have a great week, and I will see you next Sunday. All right. Have a great week, everybody. Bye bye.